Welcome to the Homeward Bound podcast by the Mortgage Guys, your ultimate guide to navigating home buying and mortgage lending. Whether you're searching for your first home or settling into your forever home, we're here to make the journey simple, clear, and exciting, helping you secure your dreams one home at a time.
Welcome back to the Homeward Bound podcast. We're excited to be with you again today. We've taken a little bit of time off and we're glad to be back filming another episode here. I'm Dave Loescher with Premier Mortgage Resources, and as always, Kyle Torgerson here with us, and we have a special guest here in the studio with us today, and we're going to talk about a topic that we've been wanting to talk about for a long time, which has to do with appraising of homes, and it's Karsten Reed. He's a local appraiser here in southern Utah, and you're going to get to hear from and meet him quite a bit here in a minute. But Kyle, we've wanted to do this topic for, I can't even think about how long.
Well, as the first one of the first things we thought of, getting this podcast together is, people need to know a few facets of why a mortgage is the way it is. Mm-hmm. And immediately we thought, we really need to talk to an appraiser, get their aspect of it. As you know, Dave, doing mortgages, appraisals sometimes make or break a deal. Yeah. Sometimes we love appraisers and sometimes we don't.
So they're either heroes or villains. And we're going to find out today what Karsten is and what he prefers to be. Why don't you give a little bit of information on Karsten and you introduce him? And
Yeah, we're excited to have Karsten in here. He's a reputable appraiser here in Cedar City. How long have you been licensed as an appraiser?
So I started appraising in 2003.
So a little bit ago.
And then was basically a fee appraiser until, still am a fee appraiser, but then I was elected as the county assessor. And so kind of fee appraiser, county assessor. So I've got kind of a background in both types of valuation. And that's a little bit of my background. Prior to that, it was, I was in a different country, but the U.S. is the best place in the world. Happy to be here.
And Karsten's legal, so we're glad to have him in our
legal. Yeah.
So we're glad you're here.
I don't think we'll have ICE coming in today to try to get you.
They drag me out of here. Who knows?
Yeah, we get a lot of thumbs up on that. I don't know, maybe thumbs down. I don't know.
Yeah, that. Subscribe and like right there. Come on.
Yep.
Let us know who you are.
But no, we're like I said, we're grateful to have Karsten with us today. I didn't realize that you'd been doing appraisals for so long.
Yeah, I started with Steve McKibben, and Steve was an appraiser here for probably close to 40 years. So he taught at SUU. He had a PhD, and then he started appraising just kind of on the side for State Bank, and it ended up being a good profession for him. So he left SUU and was an appraiser for close to 40 years, and then retired, and I took over his business. And so
what attracted you to home appraising?
I think it's kind of an interesting story, actually. So back in 2000, if you remember 2000, 2001, 2002, 2003, there was what were called liar loans, and they were stated income, stated asset loans.
Liar loans.
You could just go in. You could go into a lender and say, well, I want to buy a house, and they would say, well, okay, well, you need to make the house that you want to buy is $105,000, and you need to make $18 an hour. And if you sign this document that says that you can make $18 an hour, then you can buy this house. And I'm like, well, I guess I can make $18 an hour. I'll just sign that document. No big deal. But anyway, stated income, stated asset, you didn't have to qualify with any kind of any kind of assets or income. You basically just signed your name, and you had to have a credit score. So you had to have some credit. Mm-hmm. So I had come from Saudi Arabia, and I was looking around the university, and the homes at the time, I mean, there were homes in the $60,000 range. And I thought, gosh, I could probably rent this out and I could make money. And so I went and I didn't have a job. I mean, I had credit because I had a credit card, on my mission or whatever, but I didn't have a job. I just had moved here, and I was like, I don't want to rent. I'd rather just buy something. So I met with a real estate agent and, made an offer on a house. My agent was Steve Brown. And it was my first real estate deal was with Steve. And I went and I got a loan, and the appraisal portion of that loan was actually Dave Lawley, who just retired. And Dave came out and he whipped through that house, and in like 15 minutes, and he came out and he's like, I need a check for $400. And I was like, gosh, I need this job. That sounds great.
Hourly rate's pretty good.
Yeah, I think my rate was like 7.125 or something like that.
Yeah.
And it was a home over kind of by the college. And so, yeah, I thought, man, that kind of sounds interesting, to go walk through a home and collect a fee. That doesn't sound so bad. And so that was my initial interest in becoming an appraiser. Was I thought, boy, I could walk through homes all day long. I mean, I could make like $10,000 a day, or whatever the number I had in my mind was. So initially it was the original process of getting a loan myself and meeting the appraiser. I thought, I think I could do this. But after that, I went to the Institute for Real Estate and Appraisal Studies. So I actually went to a kind of like a trade school and did all my education, and then came back up here and started appraising. That was down in Las Vegas, Nevada. And so that was my path. Yeah.
Awesome.
So let me just ask real quick. Now, a lot of the people listening and watching, they're hearing this word appraisers. They've heard of appraisers. They've heard of appraisals. Let's just go from a very one-on-one perspective really quick. If you can give us your elevator story of what a residential appraisal is.
So it's really an analysis of an individual home. So when you're doing a fee report, you're engaged by a client to analyze a home, typically on a Fannie Mae form. Mm-hmm. And it's a specific form for mortgages. Mm-hmm. And that form has just different approaches to value, and those approaches are how you decide what the value is. There's a cost approach, an income approach, and then the sales comparison approach. And primarily what lenders want to know is that whatever they're collateralizing is secured by the value that of that thing, that property. And so typically what they're really interested in is this sales comparison approach. And that's the approach where you gather all of the data, you do your inspection, gather all the data, and then compare that home through a process to other properties to derive a value. Yeah. So there's 3 different approaches to value, but really the focus of most residential approaches is sales comparison. It's comparing your home to another home to kind of determine what the value of that is. So
I guess the question I have is when you're contracted to go out and do this appraisal, find the valuation for the lender to make an assessment if they're going to lend on this property or not. How is it that you are able to find those comparables? I mean, what do you do?
There's parameters there's guidelines that Fannie Mae has, and some of those are distance. Ideally what you want is an identical property in close proximity to whatever the subject is that you're appraising. And so you want an apple with an apple, but in a market like ours, that's not always available, and most of the time it's not even possible. And so typically what you're doing is you're looking across a marketplace and you're saying, okay, what really is the most similar and competing property to this home? I don't have something that's identical. So what is it as close to this as possible? And so you're trying to look for something that recently sold that reflects, the actual market. So time of sale is kind of a critical thing, distance, comparability. But I think one of the things that to think about it in these terms is probably the easiest term. You as an appraiser, you have, especially on a sale, right? When you have a purchase transaction, you've got a willing buyer and a willing seller, and they kind of meet these definitions of market value. You know, they're not acting under duress. They're informed. They've got an agent. They sort of have explored the market, and so when they, as a buyer, make an offer to a seller, that really is a reflection of a market price. And so when the seller is acting in kind of that same capacity, and when they agree to that number, whatever, let's say the number is 150,000, the market's already now decided what the price is. We have an established market price by informed parties. And so as an appraiser, what you're trying to do really at that point is the market's decided on the price. You're just going to see if you can support that or not. And so a lot of times what you'll see on a purchase appraisal is that the value is exactly what the contract price is. And the reason is because the market decided the price. I don't need to decide what the price is as an appraiser. The market already determined that through market forces. And so I just need to see if that's supportable with data from, sales in the marketplace and data, and through my analysis, if that's a supportable number. Typically what you'll find on, 95% or more of appraisals, you'll see that on a sale that the value will be exactly what the price is, that the contract price is.
Yeah.
And that's, that's for the reason that I just explained. And occasionally what you'll find is that market price is not supported. Somebody has a motivation to pay in excess of the market, and either that might be because they're not informed or because they really want that property and they're operating on emotion, and you may just not have the comparable sales to support it. And so what you'll find sometimes is, occasionally it's higher, the value's higher because you just can't bring it in that low because the sales are all higher, and that might be because of a different market circumstance. But sometimes it's that just the sales don't support the contract price. And so if it's not the price that's the contract price, it might be a price that's a little bit lower.
So let me ask you this. When it comes to comps, which is the term, right?
Yeah.
The cool guy in terms comps for sales comparables.
Yeah.
I'd imagine during hotter market times when there's a lot more sales, it's like low-hanging fruit. You have more of those to sift through and grab.
Super easy, yeah.
So in times when it's a slow market, where we're slowing down, you don't have a whole lot of sales.
Well, I think the challenge in appraising is where it gets subjective, where people look at it and say, well, this is not right, is when, well, a couple different circumstances, but is when the subjectivity on an appraisal is why did you choose this comparable over this comparable? Mm-hmm. A typical form has 3 comparables. A lot of times you'll see additional comparables, and what you're trying to do is narrow it down to the 3 best comparable or 6 best comparables, or whatever you feel like you need to provide in an analysis to make it credible. But a lot of times the subjectivity is, well, I picked this over this, and those things may be a little bit subjective. Mm-hmm. And that's where people have a contention with the value. They say, well, you picked this one, but not this one, and I think you should have picked that one for these reasons. A lot of times when somebody comes at me like that, I'm like, oh yeah, I didn't think about that. And
we've seen that, Kyle. I know you and I've dealt with this, where when appraisal might come in low. Yeah. And then we get whether it's the buyer or an agent, they'll sit there and say, well, what about this one that's 20 miles outside of town that sold 18 months ago, because it had a higher sales price. And we hear those kind of things, and obviously when we were talking about this time, like recent
time
comps.
Of sale is well, a lot of lenders don't want to see a sale that's outside of 6 months. It's a common, especially large banking institutions and even smaller institutions, they just don't want to see data that's older than 6 months because it's not reflective of what's happening now, which is what they're basing their financial decision on, like the bleeding edge of the market, not what happened, 10 months ago or 14, 16 months ago. That's not reflective of the current market. And so they want to see, what's going on right now. And that's why time of sale is, it's
one of the things you're kind of leaning towards in your comments there is when other comparables are being brought to light is, a reconsideration of value. Sometimes that comes up when appraisal is low, and we have to go back and see if there's a way to bolster support the sales price. They've changed a few things in the last few months, at least. Lenders can't request those anymore. It has to come directly from the client now, and so it's been interesting as we've tackled that, and a change to new policy is always something to get used to, and it's not been terrible. But I would say that 9 times out of 10 when we do that, appraisers are pretty willing to look at whatever comparables come up and at least review them and see if they fit or not. I had one a couple of months ago, same exact scenario. It was a home out in the older part of Enoch, and I was told by the agent that no, those comparables aren't good because they used ones right by that home, and that value came in a little less, and they wanted us to use some on the other side of town, a newer part, and like they're comparable-ish on square footage, but 30 years older. And anyway, so that was an interesting conversation with the agent about that part. But
I think in a market like this where you don't have a lot of conformity, where it's not like you have a ton of cookie cutter homes. A lot of homes are custom homes,
right,
and they're individual homes. And so you have a lot more, I think, as a person that's receiving a report, there's probably a lot more subjectivity in that report than, say, Las Vegas, where you have 1,000 of the same homes, or even St. George, where you've got a lot of conformity. And so, I mean, there are times certainly where an appraisal reconsideration is realistic, or even necessary for the loan process. What I would say on an appraisal reconsideration is the easiest thing is for me when somebody has an actual, I don't emotional. Anytime there's an emotional kind of response, it's hard because it's not something you can navigate logically in a form to a lender. So any kind of reconsideration has to be based upon some kind of data, and that data can be a little bit subjective. You could say, here's what I think you might have missed. These are 3 sales. Here's why they're inferior. Here's why they're superior to my house. And I think if you look at it from my perspective, X, Y, Z, there might be a little bit more value in my property than what you gave it. I think appraisers are, they're under deadlines. They've got to get things done. You're filling out this 55-page book report, and you don't always get things right. I mean, that's just the truth of the matter is, you make mistakes, or you overlook things, or whatever it might be. And so I think most appraisers are very, very willing to look at data or to look at an argument and say, I didn't really consider that, or I should consider this, and I need to make this this needs to be reflected in my report, and I can see where this person's coming from. There's probably a little bit more data. Sometimes it's not possible. There's a limitation with whatever the market is. You do have an identical sale at a lower price, or whatever the situation may be, that it's just, your cans are kind of tied. It's like, I can't get this higher, but I would say, like you said, it's the majority of the time, I think as an appraiser, I can look at somebody's argument and I can say, I had to get this done by this deadline. I did not see that information, and I need to revisit this and correct it. And so, I just tell people all the time, if you feel like there's an issue, you should always ask for a reconsideration, because, that's, you should get what's accurate. You should get what's, what is correct. So
what we're saying is appraisers are human, which is great.
Yeah, they can make a mistake as well sometimes. Karsten's very rare.
Made a lot of mistakes in my time.
Yeah. So one of the things I think that, we have these people, especially first-time home buyers, that come along in the process, and they know we need to order an appraisal, right? Because just about every transaction you do. And one of the questions that Kyle and I get a lot is, how long does that appraisal process take? So from the time you get the order,
it really varies appraiser to appraiser, and ideally you want to have it done as fast as possible, but sometimes, especially when a market's busy, I mean, I'm just thinking back to 2005, 6, and 7, we'd have 90 orders or more, and people people were saying, well, we'll close this thing in 3 weeks, and there's no appraiser that could accomplish, the task of the number of orders that they had. And, it wasn't uncommon back then to have a 6-week closing or, 7-week closing, if you remember back in the day when it was just so busy. But workload is a big challenge because, you're getting a number of assignments, and it's not like that's the only appraisal report you have. Mm-hmm. You've got to do, 30 inspections that month or 50 inspections that month. You got to write, 50-page book reports on every single one of those. And they're time consuming, especially if they're challenging. If it's not a townhome and it's a custom home, there's not, you don't have a lot of apples to apples comparison. They really become time consuming products. And so I've always because I'm also a real estate broker. And when I was a real estate broker, I would tell people, don't, try to give this lender as much time as possible, 4 weeks, 5 weeks, if you can, just in case there's any kind of an issue that comes up in this appraisal. You don't want to shortchange your client on time and then not be able to get it done because of something totally outside of the lender's control, which is a schmuck like me, not being able to get your appraisal done in time because of any number of issues. Maybe that's an access issue, maybe that's but I would say most appraisers try to get an appraisal done in 5 to 7 business days. So from when you get it to when it's completed, but it sometimes takes 2 weeks. It just, depending if it's, in a different county where, there's the surrounding counties, there are no appraisers. There's no appraiser in Beaver. There's no appraiser in Garfield. There's no appraiser in Kane County. And so, and you're 2 hours away just to do an inspection. So you're scheduling that 6 days out when you're going to be there anyways. And so you got to be a little bit thoughtful, just with regards to that. If you only have a single report to do, you could get it done in 1 or 2 days, but that's just not, not really what an appraisal business is based on, of one appraisal a week or something like that. These guys are doing a lot of volume, and it takes time. So
one of my favorite things that comes up is I'll get a call from somebody that's refinancing or buying a home, and I'll be, hey, Kyle, so just so you know, the appraiser was just here taking pictures and doing this thing, so you should have the report by the end of the day. And I take a minute and be like, well, that is certainly an important part of it, but there's a lot of analysis. They got a 50-page report to create. They got to find comparable properties. And so there's a lot going on with it, and now we're pretty lucky with the appraisers we have here in town.
I see one other thing that's and call it a misconception or confusion. We get these homeowners often that want to get their home appraised. Let's say it's a refinance.
Yeah.
And they want to get their home appraised, and they think because they put new paint in the living room, or maybe they put a new faucet in the bathtub in the master bedroom, or maybe something, that there's certain things, I guess my point I'm trying to say here, there's certain things that do move the needle on the appraised values, and there's some things that are just basically gingerbread and don't do anything, correct?
Oh yeah. My favorite story to tell is this guy did all his own finish work, and he was like, look at it, he was just kind of going on and on about the finish work, and I thought, and he's like, this has got to be worth $1 million. And I thought, well, I can tell that you did the finish work and not a professional, that's the problem. Wow. But yeah, there are certain things that do increase value. Anytime you customize a home, anytime a home has, custom finishes and features, or things like an accessory dwelling unit, like a casita, or a detached garage, a lot of things that are market desirable. For a market like ours, a lot of people have toys, right? Because we've got a lot of outdoor things, so side by sides and boats. And so you'll find in a market like ours that a detached garage or extra garage spaces have considerable value. But yeah, there's a lot of things like that. that I think what I tell people is think about what people really want in this area and in this market, and that's what you want to add to your house. A lot of people, just generally speaking, like updated modern kitchens, or they like bathrooms that are modern. Where money is probably not as well spent is in areas of a home that they don't live in. So if you think about a home like a ranch style home with a basement, the basement typically is an afterthought. That's like where they're going to stuff their junk that they don't use. Extra kids go down there, but it's not really where they live. They live on the main level of their home. And so, money typically is better spent on the main. If you're going to go spend a ton of money, it's typically better spent on the main level where you do your living and where you're actually living, not on a, in a separate level, unless it's a specialty feature. Some specialty features like a theater room or something might add value, and that could be in the basement. But
so generally speaking, is square footage the king?
Square footage is king in appraisal. Yeah, quality of construction, condition, and size are really. And I'll just give you an example. There's a guy that was building a property up in Duck Creek, and he wanted to build this highly custom home, but it was only 700 square feet. So he's going to spend $500,000 on 700 square feet. And it's hard to make an appraisal work from the sales comparison approach. To find a comparable that's 700 square feet that sold for over $300,000 is impossible. And so the way a lender looks at it is, hey, prove it to me. That they're asking for proof. Show me a 700 square foot home that sold for $500,000. If you can't, I don't believe you. And that's kind of the handcuffs that you have as an appraiser, where if you can't prove from the market that property, then that becomes very difficult to say that it has a value, other than very subjectively saying it has the value that, the $500,000 for 500 square feet, or whatever the scenario might be. So, square footage helps quite a bit, but so does quality of construction, condition.
So talk to me about like landscaping. I mean, obviously it's not the area of living, but people that have these amazing features or sprawling grass or
the problem with landscaping views, those types of things are they're subjective to an individual. And so you have to be able to prove, so you can't say anything in a report that you can't prove. Like you can't make an adjustment for landscaping if you can't prove that there's a difference in value for this particular type of landscaping. The problem is that most of that is very subjective. Everybody, when I go to a home, is like, this view is why I bought this property, and you're like, well, that's what everybody says, and so is your view really the $1 million view that your neighbors is, or what? You know what I mean? It becomes very subjective, and you have to be very objective for people. When people are lending money to you, they don't want subjectivity. They want objectivity. They want hard data. So the way that you would prove a view is you have to have a lot that's sold that has an expansive view versus a lot that doesn't, and try to determine through some kind of a paired sales analysis that there's actually a difference. And sometimes that's really difficult or impossible to prove, and you just can't make an adjustment because you think one should be made. And so it's those types of like landscaping. People will pour hundreds of thousands of dollars into their property sometimes, in some occasions, they'll just, the idea is they'll pour a significant amount and expect that the value will be returned to them in an appraisal, and that's just not always possible.
It's kind of the conversation I had with a client right now. Is he's just like, we spent like $80,000 on our landscaping, so our value is going to go up. I said, well, I would say pennies on the dollar. I hate to say it that way. I'm sure your yard's beautiful.
It could be that
I mean, the curb appeal is nice, right?
Yeah, it could be that it could increase the value of that property, but it's not always easy to justify that in a report. So
that's interesting to know and understand better.
Yeah.
So for a home seller, let's just say somebody that's going to have their home appraised, and you're going to come in, what are some things they can do, not necessarily remodel or improvement wise, but what are some things they can do? And I mean, I've seen some of these appraisal reports come back. Kyle and I get those reports back on our loans, and it's like, man, you probably should have put your underwear in the dirty clothes hamper. I mean, what kind of things do you see and what impacts that?
I think, what I tell people is that I'm really looking for quality of construction, condition. I'm looking at location. And then I'm just getting the specs on the home. Like whether your home is clean or dirty is irrelevant to me. But at the end of the day, appraisers are also humans, and I think sometimes maybe those do affect, they shouldn't, but they sometimes do affect, the cleanliness of a home or those types of things might affect some appraisers negatively. So I think just generally trying to clean up a little bit is helpful, but really, I don't know, after 25,000 appraisals, I've walked through 1 million homes. I don't even really look, it doesn't even faze me if a home is super dirty. I'm just looking at the quality of construction, condition. I'm measuring the home, I'm looking at the neighborhood. And so for me, it doesn't impact me, but I would say, from a psychological standpoint, it might be work. But the thing I also tell people is, hey, what I always appreciate is when somebody spells out for me things that I might not notice in an inspection. These are custom features of my home that make it marketable and that make it more interesting that you may not notice. I have a circulating hot water heater, hot water system. I have, whatever it is. I mean, there's tons of little features that the market is interested in, does prefer, that I may not see in a cursory inspection for an appraisal, that sometimes are really helpful when people spell out for me. So
I guess on that train of thought, does it benefit you as an appraiser if the client is there and saying, I did all these upgrades, had the roof replaced this day? I mean, is that important
personally
to
for
you,
me, I mean, I think the introverted appraiser probably does not appreciate, but I do, because I want to know what has been done.
Awesome.
And so the more that somebody's, especially dates, because as an appraiser, you're trying to estimate the economic life of different components of a house. And so if somebody says, I replaced the roof last year, it's not always obvious to me that the roof was replaced last year. Just, half the time, a 15-year-old roof looks like a new roof, especially if it's got a 50 or 60-year shingle. I don't know. And so it's really helpful when somebody does say, hey, I did this remodel this date. I did, this roof on this date. I did this update here. Because then you're taking that home and you're saying, okay, the actual life of this home might be 20 years old, but the economic life of this home, it's effectively new or near new. And so I'm going to compare it to homes that are new or near new, because that's what it is. And so it is, for me, it's really helpful. And I appreciate it when people do it. It doesn't bug me.
So if they're not there to point those things out,
just
can a homeowner make a list? And
just having a list written down is a super effective way to kind of optimize the outcome of that report.
That's good.
So talking about the economic life of things, and that's something that normal consumer doesn't think about. We do, because we're doing 30-year mortgages, and we're hoping the home can be around 31 years.
Yeah.
Do you think that's going to change anything if and when like a 50-year mortgage rolls out? Are we going to be able to document a 50-year life of a home?
Yeah, that's interesting, because they're talking about this 50-year mortgages, and I was reading a Reddit post about, well, what if a home only has a remaining economic life of 45 years or 40 years, and you've got a note for 50 years? I don't know. I don't know how that will be dealt with, because in theory, the economic life of the home has to exceed the mortgage note. Otherwise, the lender's in trouble. And so, it's kind of an interesting thought I think what might be helpful for most people are dealing with a 30-year loan. And so the problem with a 30-year loan and an appraisal typically is there's all these little areas of concern when you're doing an appraisal that are condition issues, that you have 5 years left on your water heater, you got 2 years left on your furnace. And then an appraiser has to come in and say, you've got at least 30 years left of economic life. And some homes are just really on the verge of that and need repair or improvement. And so it's not as common, I've only, in however many appraisals I've done, only encountered it a few times where I've had to say, I don't think the economic life of this home is there.
Yeah.
It needs these improvements and these things to get to an economic life that exceeds this 30-year number. But
awesome.
I can imagine that's, especially with that 50-year mortgage, because if you think about it, 50 years right now is going back into the 1970s, and there's a lot of developments that were built in the 70s, and you drive through them and you might have every other home is still in good shape. Some have been neglected. So another thing I want to talk about is that a term we hear a lot is about Zillow. And a lot of people will sit there and they'll look at Zillow and say, Zillow says my home is worth this. I'm sure you hear it as well often. And what's your take on that versus reality?
I think, the problem with Zillow in this state, I think in other states, actually, it's quite accurate. There's a lot of analytics to that type of mass valuation that are useful. But in a non-disclosure state where the majority of sales are not disclosed because we have the right to not disclose those to the government, it's very difficult for Zillow to be exact. And a lot of times I just tell people to call me, like I can look at a range and I can see if this is in the range of sales for your particular home. But Zillow is problematic here because they don't have access to all of these disclosed sales. So when you're dealing with data, you need data to determine a value. And if you don't have sales data, then it's very difficult to determine a value. But if you go on Zillow's website, they'll tell you exactly how they determine values in states like Utah, and it's through listings, and so it's not through corroborated sales, it's through other data. And so a lot of times you'll find what I would say are big data errors when they say that Zillow's estimate. I'm like, well, that's not right, or that's not even close. I think it probably is close in other states where they have access to the data and they can utilize that in their algorithm. But in Utah, it's a non-disclosure state, so it's much more difficult.
That's interesting because I came from Arizona originally back in 2009, and prior to that, they disclosed all those things. You could always find what homes sold for coming here, for the sum of $10 or whatever it says. So to not have that data, so that makes sense. So Zillow in those other states is accurate, and here not as much.
Okay.
So, I mean, the main question that a lot of our listeners are going to want, especially those here right in our area, is, what's anticipated for the market? I mean, it seems like we had no inventory, and now we've got a lot more inventory. What's kind of the economic projection that you feel would be coming up this?
So you can put on your appraiser hat as well as your real estate hat here.
Yeah,
well, I'll tell you that
crystal ball.
The challenge with appraising is really you're looking at historical data, and you can try to anticipate the future, but that's difficult, and it's challenging. But I don't know, because as the assessor, what I do is I drive through the whole county, and we're trying to look at every single property as it's built. And what I see is just incredible growth. I mean, and, subdivisions. And so I see all of the growth as the assessor. I think as an appraiser, you're just seeing what orders are coming to you. As the assessor, I'm seeing everything. And so I see a lot of growth. I mean, this county is growing. I think there's some statistic out there that Iron County has doubled in size it's 15 years or something, or 18 years, whatever the number is. But,
wow.
It was a town of 10,000 not too long ago, or a county of 10 or 12,000, and now we're 80,000 people.
Wow.
But I think just if you look at our location and our economic development and our, just what is in proximity to here, just my personal feeling is that it's poised to grow. But then there's these little economic things that will slow growth a little bit. Interest rates kind of really taper things down. But generally speaking, driving around, my mind is blown every day as I look at the development of this county. I'm like, boy, this is going to be Salt Lake pretty soon. It just feels like it's growing like
don't
wildfire.
say that.
Yeah, that's sad to think about.
Yeah. But
it's good too, right? I mean, it's opportunity, and it's people can accumulate and amass wealth if they play it right.
Yeah, there's some pluses and minuses to growth, for sure. But
so my next question is, being an appraiser and having been an appraiser for a long time, I'm sure you get some funny questions and misconceptions and things that you wish everybody knew. Enlighten us a little bit with what's common. And hey, you're an appraiser. Hey, let's talk about this.
A lot of people, I get probably at least a call a week for somebody that wants to become an appraiser.
Okay.
So I think it's a profession that you really can work from home from, right? So, and anymore, because of hybrid appraisal work, you can work from anywhere and hybrid appraise property. That means somebody else does an inspection and you're doing the analysis, you're doing the report. They're called bifurcated reports, and they're very common in the United States. There's a lot of bifurcated reports. So I get a lot of calls of people that want to become an appraiser, and it's been a great profession, and so I don't want to disparage the profession at all, but it is really challenging. And it's challenging because it takes forever to become an appraiser. You have to accumulate all these experience points, and you're working for free for some appraiser. They don't need you. You're slowing them down. They don't really need you, because they're trying to train you to become an appraiser, and that takes time away from them doing their work. So you're not making any money, and you're not making them money, and then it takes years and years and years to get your license. And I had mentioned to Dave that there's a fellow that I work with. It took him 5 years, and he was super diligent, and it just was a 5-year process to get a license to then finally be able to say, well, I can work. The problem is, even after you get that license, then a lender says, well, I need 3 years of licensed experience, and then you can join my panel, or you can. So you're 7, maybe 8 years before you're really making money, and then if you're hitting a market that is tanking, then you've spent all this time to not make it, and it's a tough profession because it's just like real estate. It's feast sometimes and famine sometimes, and it's hard to. Sometimes it's inconsistent. You'd think that because the fee is smaller that you'd have some more consistency, but sometimes it's really inconsistent, and it's it's a tough business. It takes a ton of time to become an appraiser. It's not like a real estate license where a month after you take the class you get your license. It's 5 years after you do your coursework and your apprenticeship, then you're finally qualified to fill out this form. It's really
that supports then why we see so few. I mean, we talked about how many live here locally, and it's very, very low in numbers. I mean, there's very few of you. Okay, so let's not end the podcast on that note.
Yeah, that's sad note.
Let's make something fun here. You have to, in all those years, I've seen lots and lots of properties. I mean, I think of the show Hoarders, and I think of some of those homes when people go in. I have to imagine you've seen some of those with trash up the walls, or maybe there's something else, animals living in the house. Tell us really quick a short story about maybe the craziest property you've ever seen.
So I used to have this colleague, his name is Tim, and he got an appraisal order for a property out west of town. And he's now an attorney, my former business partner. He's a big shot attorney, but he was an appraiser. And this guy went to, Oxford, super intelligent guy, but he was also kind of a neatnik. Like he was like a clean freak and a little bit of a little bit uptight that way. So he goes to this house and it's full of mold. There's mold spores everywhere. There's just junk everywhere, and it's disgusting, And it's later in the evening and it's getting dusk, and he's like, I don't want to take these mold spores, like that they're on my clothes. I don't want to take them home. Like I don't dare. So he took, he left all of his clothes at his car and his shoes, and he drove home in the Buff. And he gets to his house and his wife wasn't there, and he's like, hey, I don't have clothes on. I have, he just had his undergarments on, and he had left his clothes and his shoes, just, he's like, I'm not bringing this nastiness, this funk back to the house. But he, there's times where you're just like, oh man, you might as well just light a match here. This is not salvageable, but yeah,
I can only imagine over all those years that there's a lot of different personalities and people out there. So,
oh yeah.
Well, we've covered a lot. You have any other questions or anything?
What?
Go ahead.
Yeah. Just I want to talk really quickly about assessment and your tax valuation.
Oh, yeah.
Because I think that has, I think a lot of people, just like me, when I took office, there was lots of things I didn't know about with regards to the tax assessment side of valuation. And what I tell people all the time, because they'll call and they'll say, hey, is my assessment correct? And a lot of times it's very close to being correct. When you're mass valuing property, you do have outliers, but the majority of the data is correct or close to correct. So you'll have some outliers that are maybe much higher than, the value is higher than what it probably the market is, or lower. So you'll have some outliers. But America is such a great country because we have rights. This is a country of rights. In other countries, it just, hey, this is the value, and bugger off. But in this country, you have a right to appeal. And so I tell people all the time, they're like, I just don't feel good about my value. And I said, well, you have the right to appeal. You should exercise your right. We're a country with rights. You should exercise them. And I'm not the enemy as the assessor. What I can't do anything to your value until you appeal. I can't look at it. I can't individually, sequester your property off. You have to appeal for me to take action on your property. And so if you want us to actually look at your property individually, you have to appeal. And so otherwise we can't look at your property legally by law. We can't look at your property individually until you appeal. So we look at it once every 5 years as part of our appraisal process. But you should exercise your rights. So I tell that to people all the time. It's not like we're the enemy at the assessor's office. We actually just want to get things right. And if your value isn't correct, we want to get it right. So appeal if you don't think it's right. It's your right. You should exercise it and do it. A lot of times we'll help you in the appeal process. We can see, oh yeah, this is once you appeal and it comes to our attention, we can see that it's, things are a little bit off. You'll need to provide data with your appeal. So there's that thing. Another thing is that there are people that really struggle with taxation. There are people that struggle philosophically, but there are people that struggle financially. And I think what you might not know is that you're eligible for lots of different exemptions. So there's a primary residential exemption. And so you could own 100 homes and you could have 100 primary residential exemptions. So long as someone is using that home as their primary residence, it qualifies for an exemption. It's use-based in Utah. But there's veterans exemptions, there's circuit breaker, which is kind of an income-based exemption. There's all these exemptions that people may be eligible for with regards to a tax offset, and you ought to look into those, or you can call the assessor's office. But I think that has value. One other piece of legislation that's current that's kind of interesting is there's a House bill, I think it's 161, that currently the proposal is to increase the homeowner exemption from 45% to 60%. So if it passes this year, you'll see the tax will shift to commercial properties, and residential properties taxes will go significantly lower. You're going to get a 60% exemption on the value of your home. So.
And that's huge, because our ongoing problem we talked about in other episodes is affordability. And really it all boils down to getting that debt to income ratio to work and getting that monthly payment on the mortgage down, and being PITI, here's the T, and you're saying the T is going to come down. That's big.
Hopefully the I doesn't go up or keep going up.
Hopefully the I and the P and the P and the I.
Yeah,
don't go
both
up.
I's.
Yeah. That's good information. Thank you very much.
Yeah, and with regard to the appealing process is, I had a question. I remember calling you and having you walk me through that process, and it wasn't as difficult or invasive as I thought it was going to be. It was actually quite comfortable, and I felt respected, which is huge. And so I appreciate your help on that and how well you run things that way. It's an honor to have you on our podcast.
Yeah, thank you.
And so, for all those who are listening, don't forget to hit that like button and subscribe. And it helps us out a ton to be able to share these podcasts and be able to help people understand several of the nuances that go along with home ownership. We don't just talk about mortgage. We want to talk about everything that has to go along with it. It's one of the main ambitions for this. And anything else you want to add, Dave?
Yeah, we're just here to try to bring information to you. And thank you again, Karsten. I mean, you're a wealth of information in this whole world of assessment and evaluation of homes and real estate in general. So thank you very much.
Yeah, appreciate being here.